So we've talked about all this money printing by the Fed and putting money in people's pockets with whether it's helicopter money or other techniques. And one of the things we're seeing today, of course, is we all know the price of oil has come down a lot. And by the way, when I say a lot, this is one of the three largest, fastest declines in the price of oil in history. So this is not normal market volatility. When it goes from, let's say, $100 a barrel to $60 a barrel, using round numbers, a 40% decline in a matter of months, that's dramatic. Now, everyone says, oh, well, that's good news because gas at the pump is going to be cheaper. It's going to put money in people's pockets and they'll go out and spend it. Well, gas at the pump is cheaper. So if you're saving, let's say, $2 a gallon and you're using 100 gallons a week, it does put $200 in your pocket. That's good, but it doesn't mean people are going to spend it. They might spend some of it, they might spend all of it, but they might also pay off credit card debt, pay off car loans, pay off student loans, et cetera. That's a form of deleveraging. So it's good for the consumer. Their balance sheet is stronger. It's good to pay off debt, but you're not spending money. You're not running down to the store or the restaurant or whatever. So it is good, but it might not actually have the effect a lot of people expect. This debt deleveraging thing is still going on. Now, one of the questions is, well, at what point is that over? At what point do people feel, okay, I've saved enough, I've paid off enough debt, I've deleveraged my personal balance sheet, now I feel strong enough to go out there and start spending again, and maybe that's when the inflation will kick in. But what people don't understand is that consumers have deleveraged. It's absolutely the case. We see the data. Consumer indebtedness as a percentage of family net worth is coming down a lot, and it's lower than it has been in years. But governments have borrowed more. If you look at the global debt situation, it's worse than 2009. So yes, consumers are better off, but governments are worse off. So I look at things systemically. I look at all this individual data, but I look at the whole global financial system interconnected as a dense network of cause and effect and linkages, many of them hidden, many of them hard to find. And what could change this very quickly is a global financial catastrophe. It doesn't mean the individual is over indebted and they can't spend more. That's one little facet of this, an important one. But if all of this improvement in consumer debt has been at the expense of sovereign debt, and we have a sovereign debt crisis, either coming from emerging markets or perhaps Europe or perhaps China, that could throw the world into a financial panic and have devastating consequences. So you have to look at the whole picture. Consumer, maybe that's a little better, but governments are worse, and that's what I'm concerned about.